Hello, good evening, everyone, and thank you for coming to attend our webinar tonight. My name is Richard, and I'll be your host today. And today we are having our OTCS Market Outlook 2024. So if you are here and you have not already joined our Telegram channels, please join our Telegram channel so that you can be kept posted of upcoming events. So for OTCS Telegram channel is Online Traders Club that you can search for within the Telegram app. And for Wealth and Joy is to search for Wealth and Joy. For Wealth Lions is to search for Wealth Lions. And for Invest Kaki is by searching for Invest Kakis. So please join our Telegram channels. And if you're watching us on YouTube, please don't forget to like, subscribe, and share this video. And with that, let me get started by before introducing OTCS, I'd like to always ask this question. How is the market so far? So I know you can't answer the question, but it's okay. Let's take a look at the chart because I firmly believe in using the chart to guide us where is the market today and where we are likely to be heading. So for me, I'll just like to share this one chart, which is the chart of S&P 500. And from here, between the end of October to the end of December, we have a very, very nice uptrend, right? And then when the new year started, SPX kind of like just been chopping sideways between 4,700 and 4,800 levels. So we are still chopping within the 4,700 and 4,800 levels currently. So where is the market? To me, the market currently is having the sideways direction, and the key levels that we need to keep and look out for would be 4,700 as the support and 4,800 as the resistance. So if it break 4,800, expect SPX to continue to go up. If it drop below 4,700, I will expect SPX to go down. Okay, so that's my little insight into where I think SPX is. But today we are here to listen to our two experts to share with us about their insights of where the market is heading. So I will not take up too much of your time. Let me now move on to share with you more about OTCS. OTCS stands for Online Traders Club Singapore, and we are a non-profit society formed in 2005. And we are a community of traders and investors, mainly here in Singapore. And OTCS, to me, is a place where we network, share, and learn, and we do it through a series of workshops, courses, and our library. For workshops and webinars, we aim to have about 6 to 10 a year, and it is free for our members to attend. And since COVID till now, we have been keeping it free for our members as well as the public. So these are some of the pictures from our in-person events. And for courses, we aim to have about 2 to 4 a year. And normally what we do is that we will do a group buy with trainers to get a discount for our members to attend the trainers' courses. And we aim to have about 2 to 4 a year. And we also have a library, but since COVID, it has been closed. But when we were having it open, there was about $6,000 worth of resources that our members can borrow. So currently, it is still closed. So again, LTCS is a place where we network, share, and learn, and we do it through a series of workshops, courses, and our library. So the fee to join us as a member is $120 a year, but for a time-limited period only, it is $60. And since COVID till now, we have been keeping it free. So if to learn more about us, please visit onlinetradersclub.org. And if you're just joining us, don't forget to join our Telegram channel to be kept posted of upcoming events. If you prefer to receive it in email format, do join our mailing list as well. If you're watching us on YouTube, please don't forget to like, subscribe, and share. And here, I'd like to give a special shout out to our OTCS crew. They are the unsung heroes who are working behind the scenes in our physical events, helping us out, such as what you're seeing here, to distribute food and water to the attendees who come to our physical events. So thank you very much. You know who you are. And now for the very important slide, the disclaimer. You are responsible for your own profits and losses. The speaker's opinions are their own and does not represent OTCS opinions. OTCS, its office holders, associates, and sponsors are not responsible nor liable for your losses. OTCS events are for educational purposes only and should not be construed as advice. And when you're in doubt, please seek professional help. So with that out of the way, let me now share with you our agenda for today. We have two speakers. They have been regular in speaking at our Market Outlook events, and they are none other than James Yeo and Ian Low, who will be covering the domain in their expertise, which is the markets, the bonds markets, Singapore markets, US markets. All right, so they may be having some overlaps in terms of the area of coverage, but that's the good thing about having multiple speakers covering the similar areas of so that we can hear different views from different experts. So without further ado, let me now hand over the stage to our first speaker for today, Mr. James Yeo. So James, I'll hand over the stage to you now.
Hi, Richard. Thank you very much. Hi, audience. Thanks for joining this webinar. If you can see and hear me, can you type yes in the chat box?
Oh, they can't type.
Oh, they can't type. Oh,
yeah,
right,
don't worry.
right.
Can hear and see you because I
Okay,
can
okay,
hear and see
okay.
you.
Can. Okay. Now let me share my screen. Okay. Okay. So I'll be sharing my Google browser because after which during the discussion for the Q&A, as well as if you have any questions on my the stocks that I discussed later on, I will be sharing with you on how I decided to pick up some of these stocks, right, through the different platforms. Okay, so anyway, I'll be going through the market outlook for 2024. Okay, thank you, Richard, once again for inviting me. Okay, so just a quick disclaimer before that. Okay, this presentation is for information purposes only. All right, does not constitute to any form of recommendation or advice. Okay, and the views expressed by me, okay, are in no way my reflective of that. Okay, please make your own decisions, right? This is the disclaimer for today. Okay, so just now Richard already covered the agenda, all right, about the market outlook and how we're gonna have maybe some kind of overlap. Okay, so this is the agenda for my slides, all right. I'm gonna talk about Singapore as well as the US markets. And then I will further dive into the industry sectors. All right. So which are the industries that are gonna be beneficial, or which are the industries that maybe will be kind of a muted growth in this coming year. And last but not least, I will also touch on a few case studies. In particular, okay, some of my own stocks that are on my watch list, right? So I will be going through some of them and why I decided to pick on them. Okay, so without further ado, let's dive into first thing first. Let's talk about myself. All right, if you are not familiar with me, okay, my name is James. Okay, and I have been writing for a lot of famous publications like Motley Fool Singapore. So now they have switched gears to call the smartinvestor.com.sg. All right. Okay. Dollars and Cents, Sidley, Yahoo Finance, and also Investor One. Okay. So there are a lot of investing publications whereby they are all online, and you can actually just just do a quick Google search. You can find my name in some of the articles over there. All right. And on top of that, okay, I used to write a lot of articles, and to certain extent, right, I decided to why not, right, go for a skills future cert, so that I can take it up to the next level, so I can get my skills future cert, and then I can go on to teach investment courses, which I will share towards the end of my slides. All right. And okay, so on top of all this, right, I'm actually the founder of smallcapasia.com, and I also started a YouTube channel called Invest Kaki. So for those who are watching this webinar through the YouTube channel, you can actually just go to the YouTube channel and search for Invest Kaki. I believe my face will show up in all the videos, so you can just subscribe to it. Okay, so I'm also SGX Academy speaker as well. I didn't put it inside the text here. So going forward, for this year, I'm more active in this, having all these SGX webinars. So because I'm more intertwined with them now, and they have been inviting me to also speak to some of their events. All right. Okay, so if you are interested in following me on YouTube, okay, you can actually scan this QR code, or you can just type it in this link called bit.ly/sub, okay, sub invest kaki. And why do you want to follow me on YouTube? Okay, it's because of the past videos that I've done. Uh, Examples like the Singapore stocks to celebrate National Day. All right, I also covered ComfortDelGro when it was trading at 15-year low. Back when I covered Comfort, it was trading at around $1. Right now, I think it's already $1.40. And I believe, okay, personally right, I think that ComfortDelGro has more room to grow because of all the price increases. So they talk about inflation, and then they are putting in a lot of platform fees surcharge and things like that. And for me, I do use Comfort because of my two young kids, right? I cannot go for Grab car and all that. I have to go for taxi, and Comfort just seems to have more taxis in the running the roads because they have the biggest market share, right? So I bopian, I have to use ComfortDelGro. And that's the reason why I decided to cover Comfort, and I see that the share price has been going up steadily. On the other hand, I do also follow US stocks. So when the US stocks, especially the bank stocks, right, like Silvergate, Silicon Valley banks, when they went bankrupt, I think last year, I actually did a very quick video to cover that versus our three local banks. So we can see the deep contrast, all right, comparing the US bank and the Singapore banks. So I decided to do a quick video on that, as well as the retail REITs. So I cover a lot of REITs because that's what Singaporeans like, right? So if you were to follow me on YouTube, you will be able to you will be able to see a lot of blue chip stocks as well as REITs in my YouTube channel. Okay, so that's all. Back to the main topic for today's agenda, right? The markets in 2024. So, like I mentioned, I will be covering the Singapore market. Okay, you can see that I have a very nice picture over here, and the US markets as well. All right. So first things first. Let's talk about Singapore first. Okay. So we are all familiar with the Singapore market, I presume. Okay, but do you know that in the past 10 years, okay, this chart is extracted just 2-3 days ago. So in the past decade, you can see that our Singapore Straits Times Index hasn't gone anywhere. Okay, so if you were to be vested in the Straits Times Index since 10 years ago, apart from getting the stable dividend yields okay, the price hasn't gone anywhere. So why is it like so I would say still so disappointing, like, in the sense that when you compare to other markets like US, even the Europe markets, all their exchanges have actually been going up, except for Singapore. So let's talk about the Straits Times Index, right? We have 30 constituents in the index itself. And now let's make a guess, okay? How many property related counters are there in the STI index? Okay, I know that y'all cannot type it inside the chat box, but just make a quick guess lah in your mind. How many property related counters are there? Is it like 5, or is it like 10, or is it like 15? Okay, so without further ado, let me review the answer. Out of the 30 stocks in the STI index, we have 10 stocks that are property related. So counters like CapitaLand Invest, City Developments, Hong Kong Land, all the Maple Tree Trust, and as well as UOL. And not to forget, right, we have a lot of counters that are also invested partially in the property counters. Okay, so we have things like the other REITs or trusts that are vested inside. All right. So now let's take a look at the Singapore economic outlook. So we have two sides. One is the good and one is the bad. For the good wise, okay, I extracted this out from the the Singapore government website lah. Okay, the MTI, okay, the trade and the industry. So they are saying that the electronics and manufacturing sector is going to be good after a downturn for the the manufacturing sector because of all this oversupply. Even the TSMC, they are saying that there's oversupply and the chips are going down and things like that. So going forward in the next year, or sorry, in this year itself, sorry, the sector is going to have increased demand in the global semiconductor sales and a favorable outlook for the AI related chips. Okay, so the forecast will be promising, all right, and this growth will extend beyond this year into 2025 to 2028. So what they're trying to say is that the worst is over, right? So we're gonna have a couple of good years in the next few years, all right? And on top of that, we have F&B, travel, and hospitality. So if you think about it, right, travel wise, a lot of us has been traveling around the world. For me personally, I went to Hong Kong Disneyland just 1 month ago, and I would say that it's bustling with activity. SIA itself, you look at their results, wow, fascinating. Their net profit, their sales are up like more than double digits, right? And this growth, right, has come off like a very strong spring post pandemic, but a lot of analysts are saying that it will continue to grow going forward, especially, and on top of that, right, our Singapore F&B industry is also projected to grow, although at a very slow pace of around 2% over the next 4 years. It's still still growing lah. The reason why, if you were to ask me, is that F&B, right, they are gonna increase the prices. When you think about it, like Ya Kun, Old Chang Kee, all that, they're gonna increase prices. Just like even if they increase by a few percentage, that will trickle down to the earnings, all right, and the earnings will continue to grow. Same thing goes for the hospitality. A lot of traveling means that a lot of people are coming to Singapore. They're gonna visit the Genting Singapore casino. They're gonna visit our hotels. So all in all, right, the hospitality sector will be benefit from all this growth as well. Okay, so we have now let's take a look at the counters itself lah. So we have semicon, travel, and F&B stocks. Semicon wise, we have the counters that I can think of, right, are Venture Corporation, okay, our biggest semicon player in Singapore itself, right, as well as Grand Venture. So Grand Venture has suffered from a very deep cut in all this demand for the for their manufacturing services, okay, and as a result their profits have fallen double digits and all that, but they are very optimistic. If you look at their management commentary and things like that, they are all saying the same thing. So semicon, the worst is over in 2023. Looking ahead, they will be cautiously optimistic. So if you were to go and look at all these semicon stocks, right, all their corporate presentation slides, they are all saying the same tone. Okay. And travel, so SIA, like I mentioned, right, SIA and Genting Singapore, okay, as well as even those smaller counters like Straco. Okay, Straco is the one that operates our Singapore Flyer. So all these are the management are also very I would say like very positive lah, okay, on the outlook ahead. And then for the F&B, we also have a lot of F&B because Singaporeans like to eat, right? We have Swensen. Swensen is by ABR Holdings. We have maybe the Japan food, okay, with Ajisan Ramen and all that is under Japan food. And if you were to ask me, my favorite pick would be RENS because I frequently visit Ichiban Sushi, okay, because okay, my wife likes to go lah, so I will also follow lah. So we even have a membership, the with Ichiban Sushi. So presumably I always eat there and I find their food still okay, still not so bad. So I would like to also showcase this stock line over here. Okay, so now let's look at the poor economic outlook of Singapore. So again, right, based on the Singapore government's forecast, what they are saying is that the banking, financial sectors are going to be uncertain, okay, or maybe they're going to come down a bit due to the very high expectations that the interest rates will come down. So imagine when the interest rates come down, so the banking sector will charge lower interest rates, but at the same time, they are still faced with all the effects of high interest rates. That means all the businesses, okay, maybe they cannot tahan all these high interest rates already. They decided to close shop or they decided to go bankrupt. All these will come, they wouldn't come immediately. They will come maybe a few months or 1 year later. So the banks itself will be hit by all these next wave of bankruptcy, but at the same time they will be forced, when the US lower their interest rates, they also have to lower the interest rates. So they are charging lower interest rates, but at the same time they're going to face all these bankruptcies by their loans lah, so-called the corporations. All right. And other than that, right, we have also all these escalating geopolitical conflicts, i.e. we have Russia-Ukraine war still ongoing after 1 year plus. Still, I don't know how they're gonna continue so long, right? And on top of that, we have also the Israel versus the Hamas, right? So is also escalating into the Middle East versus US, sending all their militaries to protect the sea itself. So this has a very global uncertainty, and and it's gonna also disrupt the raw material supplies. And this pertains, I would say, in particular to the Middle East, the route, whereby when there's a lot of disruptions, like the pirates, they are gonna cause disruptions in the shipping industry, right? So that will impact on the raw materials, and then it will impact on all the pricing and the supply chains. So if you were to ask me what are some of the stocks that will be impacted, okay, for the financial and raw material area, of course, is our three local banks, UOB, DBS, and OCBC. Okay, very clear cut are the financial sector. Okay, although if you were to ask me, I think they will still weather it well lah. They are so strong, balance sheet wise. Even if they are faced with lower interest rates and all that, no worries. It's just maybe their profits come down for the year, but all in all, they can still grow their market share outside Singapore. You know, so in the long run, they will still continue to grow lah. Raw material wise, okay, so two counters that I can think of is Olam as well as Wilmar. So in fact, if you were to look at their results, okay, maybe they are not so good as compared to the past. So if you think about it, all this is very hard to forecast. Okay, so if imagine if I were to ask you, what is the price of sugar going to be in 1 year's time? What is the price of wheat going to be in 6 months' times? So by and large, as retail investor, we don't have information of all this. Even the corporations, even Olam or Wilmar, they won't be able to know because they are always affected by the global demand and supply. If there's a ongoing war, if let's say Russia decided to block the port in the wheat, right, in the in the Ukraine region or their own port or things like that, so it will impact the prices of wheat, and the prices of wheat will snowball into other things as well. So investing in this kind of a commodity firms is actually a very tough thing to do because even they cannot predict. So more what makes us, right, as average Joe investors, we won't even be able to predict as much, right? Okay, now so I've covered the economic outlook. For Singapore itself, I would say that it's a balance lah. It has always been there. STI has always been stable for the past 10 years, and for the coming year, I don't think that there's gonna be much uncertainty. Not much uncertainty, much volatility. So the price not gonna move much. And for the low interest rates coming down, I think it will benefit the property counters. So given that we have 10 property counters out of 30 stocks in the STI index, so that will be beneficial for STI, okay, going forward in this year. Also, that's my take lah, okay. But I'm not a fan of STI index. Presumably, if you look at the past 10 years, it has been going nowhere. So if you want me to pick a few stocks, I will go for two things lah. One is value and the other one is dividends. Okay. So first of all, when it comes to value, and to couple with the industry theme, right? So just now I mentioned about semicon, right? Semicon, the turnaround, plus some kind of a value aspect to it. So my watch list is actually nano film. Okay, if you can see how their products being applied throughout the different places, like garage, you have all the fuel cell. Okay, even Temasek is partnering with them to do the fuel cell coating. Okay, you have all these 5G, the mobile phones, the computers, laptops, printers, all of them need some kind of coating. Okay, so this will pertain to nanofilm and their expertise. All right, so nanofilm, I believe will benefit from the coming year turn around, okay, especially in the semicon industry, as well as because it has fallen so much, right? And a lot of investors have given up hope on nanofilm, so to speak. All right, so nanofilm. The second one that I want to share is Raffles Medical. So I believe a lot of us are familiar with Raffles Medical. No need to say much. But given that, okay, Raffles Medical over the past 5 years, they also have been going nowhere. Right now, it's trading at around $1 because of their losses incurred for expanding into China itself. But if you were to ask me, right, their core operations still very strong. You have all the Raffles Hospital, you have the clinics. People sick, okay, people still go to see clinics. So more or less resilient and defensive. All right, so this is trading at a point whereby I find that they are doing a lot of share buybacks, so there's some kind of a support area. So this is my pick. The third one, okay, the third one is none other than Tiger Balm. Okay, so Tiger Balm, if you don't know, their counter is Hopa Corporation. Okay, so Tiger Balm, I do use them for myself. So more or less also pretty defensive, a kind of a consumer staples. I think when it comes to inflation, right, they will be able to push up, the prices of all these products, and they also have a big chunk of investments in all the different banks and all that. So more or less, very defensive stock lah. Okay, so given that it has come down by a bit, this is what I would say will interest me lah. So these three forms my Singapore watch list. All right. So now moving on to the US, okay, the US market. So where a lot of us know, because Singapore don't just give the kind of returns that we want, right? So a lot of us like to go to the US market. And when I want to talk about, or I want to find out about the US market valuations, right? I actually go to this website called currentmarketvaluation.com. Okay, it's pretty interesting in the sense that they show different models, okay, which I will go through here lah. The first one is interest rates. So they compare the S&P 500 versus the interest rate. And Warren Buffett, okay, what is the market value of the US S&P 500 versus the US GDP itself? And last but not least, they also compare the cyclical adjusted PE ratio. Okay, so given like over the past decades, the past like 30 years, what is the adjusted PE ratio according to inflation? So now I have already grabbed the screenshot, so I'm gonna share it with you. First one is the interest rates. So they use the 10-year treasury yield rates versus the composite score of S&P 500 value. So they find out that actually this interest rates indicator, right, as depicted by the purple line, is around in the middle, okay, below the 1 times standard deviation. So I would say that this is just nice, not overvalued or not undervalued. Okay, so this model actually look at the relative performance of the US stock market given the current interest rates. The other one that a lot of investors like to see is the Buffett indicator. Okay, and you can go check out the website. They will explain what is this Buffett indicator about. Okay, basically they compare the market value of the whole S&P 500. Imagine all the 500 stocks, their market value, and then what is the GDP of the US economy. So they say that if the market value of all the stocks, right, have gone up by too much compared to what they are making for the economy itself, that means it's a sign that is overvalued. So right now, as of 30 November, okay, 2023, so maybe 2 months back, is at 175%. Okay, so this has come down by a bit since what I've covered, I think last year. All right, when I covered it last year, it was trading above 200%. So it has come down by a bit, but still rather overvalued at the moment. So you can see that the long-term line, maybe it will be at around 130%. So now 175%, kind of high, okay, in relativity. The third ratio I want to share with you is this cyclical adjusted one, okay, where they take the current price divided by the average earnings over the past 10 years. So this will smooth out the volatility, okay. And what we are seeing here is that around 30 30% north of the historical average at 20%. Okay, so the 10-year, okay, cap ratio in the past is around 20%. So right now is at 30%. So it will be overvalued at the moment. So if you were to look at all the three indicators, right now the US market is actually overvalued lah. Okay. Okay, so let's see what the analysts or the economists, the different banks are saying about the US economic outlook. Okay, so first of all, JP Morgan is saying that there is a slow global growth for the market outlook for 2024. And they even say that, right, they are seeing a chance of recession, okay, in the first half of 2024, 25% chance lah, followed by 45% chance in the second half, and the 60% chance of recession by first half 2025. So basically, JP Morgan is saying that they are very pessimistic, okay, of the economy growth in this year and the next. Okay, so now let's look at what Morgan Stanley is saying. Okay, so Morgan Stanley is saying that the US stock market rally at the end of 2023 is also saying that is overvalued right now. So there's very little room for error because it went up so much, right? If any bad news come out, it will be going down, okay? And if there's any good news, maybe it will just go up by a bit, all right? And they are saying that the analyst estimates for the 2024 may be too optimistic. So there will be some kind of a tapering in the US economic growth. All right. The third one, Forbes. All right. Forbes also is saying that US will have recession risk. Okay. Especially when you look at the interest rates, right? They are pressuring US stocks, US corporations. So corporations will also mean that the private companies they are also facing very high interest rates, and all these are coming to haunt them, okay, and they may default, and all these default rates will continue to rise in this year itself. And Forbes is saying that is even more pessimistic. They are saying that there's a 51.8% chance of a US recession in the next 12 months. Okay, so even the US Federal Reserve, they are cutting their economic growth expectations for 2024, expecting a US unemployment rate to go up this year itself. So all in all, right, they are all very pessimistic in this year itself, even though we are talking about lower interest rates lah, lower inflations and things like that. Wow, everyone is so pessimistic. This actually is a because due to the reason that there are being layoffs in the market. Okay, and if you go and check out this website called layoffs.fyi for info, right? layoffs.fyi, you can see that there are a lot of tech companies laying off people in just the few months before this webinar, right? You have Google. Google already lay off, I think last year, a few months back only. And just last week or just in the past few days, Google is cutting jobs again. So we have also Amazon, we have Meta. All of them are earning, so much, earning billions of dollars, and they are saying that, oh, we don't need all these employees. Why? Because of AI. So when AI comes out, all this automation is being done. They don't need so many people. When they cut the jobs, their results will improve. All right. But the impact is that all these people getting laid off, right, will lead to higher unemployment rate and will maybe cause the recession because they don't have the kind of income required to support the property market, support the stock market and all that. So, all in all, right, all these layoffs are going to play a part. Maybe not now because they have savings, but my belief, my take is that, in the coming year, well, maybe they want to tighten their purse. They're gonna, sell their stock, sell their properties, go for a more simple lifestyle. All this is gonna be have the impact, not so soon, but in the coming year or 2025 itself. Okay, so if I were to summarize the US Outlook 2024, it will be that there is little room for error. Market dynamics in 2023 to continue. So what happening in 2023, like the layoffs, okay, like high inflation, interest rates still gonna remain high. Okay, that's what I believe based on what I've been reading. Even though they are saying that there will be cuts of the rate hikes, but maybe not so much. All right, so the market dynamics still gonna continue, and we also forget. A lot of us forget that there will be an upcoming election, so it will be adding fuel to all this global uncertainty. So Donald Trump is gonna go up against Joe Biden again. So all this is gonna play a part in the very confusing U.S. economy going forward. And let's take a step back, right? We look at 2023, see how is the market performing. Okay, so market for the S&P 500 itself is actually up more than 20%. Okay, very good year in 2023. But a big part of it is actually contributed by this Magnificent Seven. If you go and Google this Magnificent Seven, like Alphabet lah, Amazon lah, all right, all of them are contributing. Actually, all of them, this Magnificent Seven, right, in total, they have gone up more than 70% in the past year, in 2023. Nvidia is actually a big stock, it's a big winner there. Okay. And in the past 5 years itself, Magnificent Seven, okay, you have all these stocks here already, Meta, Nvidia, Microsoft, Tesla. They have returned magnificently, right? Pardon the pun. Okay, so from 2020 to 2024, they have already gone up like maybe more than 300%. And if you were to compare it to Nasdaq and S&P 500, wow, you will be making a lot more money if you have invested in just these 7 stocks itself. Okay, in the past 5 years. So, if you were to ask me, I would say with all this uncertainty, right, I would like to go for quality stocks. I say that quality will reign supreme. Okay, and this is also backed by a lot of studies, right? Like, especially when you look at studies like this, 1984 to 2021, equity performance has been factored as been as a result of this quality factor and low beta factor. Low beta means it doesn't move in accordance to the market itself. Okay, a beta of 1 means that the stock will move equally with the S&P 500. So let's say a beta of 0.5 means that S&P 500 move up 10%, the stock will move 5%. So the same thing lah, inverse. If the S&P 500 drop 10%, the stock will only drop 5%. Okay, for a beta 0.5 times. Okay, so if you were to take a look, right, over the past decades, quality has reigned supreme. Okay, and I would like to look at the characteristics of high quality stocks. Okay, if you were to want to screen for quality stocks yourself, so these are some of the factors that you can consider. So one of it is strong and stable earnings. So it has been to make money or at least have a free cash flow itself, right? This will be a determinant of these quality stocks. So other things that we look at is economic mode lah, management team, a growing industry, as well as a strong balance sheet. Okay. So you notice that we don't talk a lot about financial numbers itself. As long as they have a consistent growth for their maybe their top line or their profits, and maybe they have been churning out free cash flow. So all this is already enough. What matters more about quality stocks is like whether you have the economic mode to continue this consistent growth going forward. So we are looking ahead lah, not looking at the back. Okay, let me take a sip of water. And if you look at this table over here, you can compare quality stocks versus growth stocks. We are not looking at growth stocks because growth stocks, you can see, although they grow very fast, like during the pandemic, they grow like more than 500%, 10,000% or whatever. They also fall pretty fast. All these SIA stocks, like if I were to give an example, like maybe C Limited, okay, Shopee, we have all these specs. All of them went up very fast and all of them come down very fast also. Okay, so quality stocks itself, they are growing moderately, like maybe 10 to 20%, but they are more steady growth, more sustainable. And I would say that a lot of them are well-established household names. Okay, so I would say if you were to want to find some stock ideas, you can actually check out this Fundsmith LLP. Okay, so this is a fund that focuses on quality stocks. Okay, and is by this very famous guy called Terry Smith. Okay, he created this Fundsmith for many years, and he has very systematic way of finding quality stocks lah. So basically, you want to find wonderful companies, and you don't overpay for them, and then you do nothing. So you let the winners just grow by themselves. Okay. So if you want to take a look at this, I actually did a screenshot. Okay, I put it over here. I actually have access to this website called finchat.io. Okay, it is a AI tool that I can share with you lah. Maybe I just do a quick run through here. Okay, so this is actually finchat.io. You can see that I search for the Fundsmith, okay, the fund itself, and you can see that I've grabbed a screenshot over here. Okay, so you can check out the different companies or their filings, all right, inside here. Okay, so coming back to the slides. Okay, we have a couple of names that we all know. So Microsoft is one of them. Meta platforms with like Facebook, right? Visa, PepsiCo, all right, Alphabet, even Nike. So and also last but not least, Apple. Okay, so all these quality stocks, they grow maybe at a stable pace, but more importantly, over the long run, they'll be able to grow and give you 200%, 300% kind of a returns, like what I shared with you in the Magnificent Seven. Okay, so I think you also want to find out about the US watch list, right? Okay, so now it's 8:20. We will have a bit of time for Q&A. So I will just briefly go through the watch list stocks I have. Okay, so when it comes to my US stocks, I like to follow this Elon Musk advice. Okay, investing advice, which makes a lot of sense lah. Okay, that's why I like to share with you here as well. Okay, so Elon Musk says that he has been asked a lot on how he invests. So he says that you can buy stock in the companies that make products and services you believe in, and so that is buying. So when do you sell? You can sell them if you think that their products and services are trending worse. Okay, so buy and sell. So very good. He covered the entire, like maybe what you need to know about investing or finance in just 2 sentences. How to buy and sell. And more importantly, about psychology, he says that don't panic when the market does. So basically, just buy and hold lah. Only when the products and services are no longer good, then you sell them, right? In the long term, you will do good for your portfolio itself. Okay, so with that in mind, I will share with you what I personally use. Okay, so first stock I have is Alphabet. Um, I like to share a lot of my other, you know, because I conduct investing workshops for Skills Future as well, and I also conduct other webinars. And I always say that I cannot live without Alphabet, because I'm a YouTuber myself. I use YouTube a lot. My phone, I use Android phone, Samsung. Okay, I uh, I have Google Play Store. All right. Whenever I go to somewhere, I use Google Maps, and even my TV is powered by Android. So if you take out Alphabet, I don't know how am I able to function. All my to-do list is also in Google Calendar. So I have a very bad memory, not like my wife. Okay, so if I want to find out what I'm supposed to do in the next hour or the afternoon, okay, or at night, I will just go to my Google Calendar. Okay, I cannot function without Google. This is how important it is to me. The second stock that I want to share is McDonald's. All right, so McDonald's itself, although it's been a very established brand, so many outlets globally, but I believe the power of McDonald's don't lie in the number of outlets. It lies in the fact that they are able to increase the prices every single year. So imagine last time we eat ice cream cone. For my time, when I'm still a student, I don't know about y'all lah. When I'm a student, maybe 10 plus years, like maybe 16 years old, O level. The ice cream cone is only 40 cents, 50 cents. Now it's $1 or $1 plus with this kind of new flavors, Kueh Bangkit flavor, right? So they can continue to increase price every single year, but you have to pay for it because why? It's everywhere, and secondly, my kids like to go McDonald's, so I definitely have to pay for them. The third stock is a bit of a tech stock. It's called Shopify. Okay, why I want to talk about Shopify is because it's linked to trend that I have I've seen in the past few weeks. The dominant trend is that AI is really taking taking impact in the sense of the layoffs, in the sense whereby a lot of jobs are being replaced by AI, and Shopify uses AI to a very good benefit for their merchants. If you go and check out all these YouTube videos by Shopify, right, they are always saying that the AI tools help them to save so much time, in the sense that if you have such a very good AI tool in for the Shopify merchants to use, right, they're gonna use and they're gonna stick around in Shopify, and that will benefit Shopify stock in the long term itself. Okay, so we have Alphabet, McDonald's, and Shopify in my US stock watch list. Okay, so I've come to the end of my presentation. So next, what you can do, all right, if you are looking for more stock ideas, you can actually join my Patreon membership. I've this Patreon that I just started a few months back. All right, it's called patreon.com/investkaki. If I can, I will share this link later down in the chat box later. Okay, so basically in this Patreon membership, I do have a US stock quality fund, okay, which I put in 10,000 of my own money, and I'm going to buy a lot of these quality stocks. All right. So if you join my membership, you can actually follow me through. On top of that, I also will be coming up with a dividend portfolio. Okay, so the 200,000 dividend portfolio, this is based on the 4% retirement rule, because like what uh, a lot of retirees like my dad, right, they always want to find, what are the dividend stocks that can give them some kind of passive income lah, with all these dividend cash flows. And I've spoken to my dad before. He's actually looking for something like this, whereby I just show him, okay, what I invest in. No need for very quick turnaround, but maybe just a very quick 10 dividend growth stocks, or 10 to 15. And then on a quarterly basis, I will look at them, or even like maybe when I have any new ideas, okay, I will put it inside this retirement portfolio. More importantly, is giving out at least 4% dividend yield, so you can make sure that all these stocks will give you some kind of a passive income for the year. Okay, so this is it for the stock ideas. You can join my Patreon membership if you want to be you know have better investing knowledge, or educated in the sense whereby I will talk about US stocks. So let's say if you're not familiar with US stocks, you want to be educated and in this space. Okay, I'm running this skills future workshop. You can get up to 70% subsidies by the government. All right, it's accredited by Institute of Banking and Finance (IBF), as well as up to 70% skills future credit eligible. So you have I think 1,000, right, for Singaporeans. I can use that to actually defray this costs, uh, the workshop cost itself. Okay, so I will be leaving this link down later also, so you can actually register interest for my upcoming skills future workshop. Okay, so I ongoing. Okay, we haven't planned for the next skills future workshop. I believe it will be in April, but you can register interest first, and once we have enough numbers, we will open up for registration, the actual registration. All right, so this is it for me. Now I will move on to the FAQ. Sorry, I've taken up so much time. Now it's 8:30, so maybe just 2 or 3 questions lah. Okay.
Sure.
Thank you.
Thank you, James. Yeah, you can leave that slide on, so that if anybody is interested, you can just go ahead and type in the links, so that you can check out what James has to offer. Okay, so if you have questions for James, can you please type into the chat box you see on the screen? So you can scroll, if you're using a mobile device, you may need to scroll up or down to look for a chat box. And if you're using the web browser on a desktop, then you can just type it into the chat box on the bottom right of the screen. James, you want to go back to that slide instead of this tunnel vision?
Oh, okay, sorry.
Okay, can. Okay, yeah. So if you have questions for James, please type into the chat box you see on the screen. Okay, so while attendees are typing in the questions, if any, I have a few questions, James, if you
Mm,
don't mind.
thank you.
Okay, I noticed that your stock pick is quite unusual.
Mm,
You know, unusual as in they are not the very the mainstream,
yeah.
right? So, is there any reason, like for example, in your Singapore stocks, you pick Nanofilm, Raffles Medical, and Huapa. Well, Huapa, I only remember them for that that
Hyperbound.
that no, that's very scary place.
Oh, yeah. All
Yeah,
demolished
that
already.
I don't know what you call that, man.
Yeah.
So, uh, how are they as a stock? I mean,
Okay.
you think they are?
Actually, very good question. I actually cracked my brains to come up with this more of like out of the mill stocks because when you go and look at analyst reports, or when you look at the stock prices in the STI index, or even if you listen to whatever other people talk about stocks, right? It's always the same thing. REITs lah,
Banks,
blue chip stocks lah. Yeah,
SIA.
yeah, SIA, like Sheng Siong. So I actually did some research lah. So I find out that I don't want to just cover the mainstream stocks. I want to provide a bit more value lah for those who come to this webinar. So I did some research, and these are the stocks that I like personally. So it's also not that abstract in the sense you have Raffles Medical. So is the share price has come down by a bit. I do see some kind of a value or support area lah. So this makes me why I want to pick these few stocks. Yeah.
I see, I see. Are they more, you think they are more for capital gain or more for dividend?
I think Raffles Medical will be both, because they do give out dividends as well at a constant basis. For Nanofilm is definitely capital gains because they don't give out dividends. For Hopa also both, very stable. They also give dividends, so it's both lah.
I
Dividend
see, I
growth
see.
kind of thing. Yeah.
Okay. So, for US, you picked Google, McDonald's, and Shopify.
Yeah.
So you pick any of the AI, I know the other Mac 7.
Oh,
So
so
any reason for that?
same thing lah. Okay, so alphabet. I didn't want to choose all the Magnificent Seven, so I decided to just pick one, which is my favorite is alphabet. So I decided, for the other two, why not same thing lah. I go and think of what is maybe a eye opener for webinars. I mean for the attendees lah. So one of it I personally like is McDonald's. I Every time I just use the app lah, so it somehow just pop up in my mind. Yeah, I always use the McDonald's app lah for deals, especially when nowadays high inflation, right? Why not use McDonald's? Always got deals. And for Shopify, because personally, my wife likes to shop in the stores, the online stores, all these blog shops, or even just the kind of online blog shops lah. They all powered by Shopify. So I did some research that like Love Bondito is actually by Shopify. When my wife shops for clothes at Love Bondito, I'm checking out whether all this translate to growth at the Shopify itself. Yeah, so I decided to share with all of you lah, about Shopify. Yeah.
I see. So Thanks for answering those few questions.
Yeah.
So in your view, do you think that the interest rate, will there be, that many cuts as expected, or the inflation will stay high and the Fed will not cut so soon?
Um, Personally, I think that the rate cuts won't be as many as what we think. Maybe won't be as, because when they increase, right, it's stock markets are like that. When they increase very slowly, right? Then they drop very fast. But interest rates, I feel that it's the other way around. So when you increase interest rates, when the Fed want to increase interest rates, they go up very fast. Every meeting they will increase the rate. But when it comes to cutting the rate, they won't go so fast. The reason is because they want to see what is the impact. Like let's say I cut 0.25%. I want to see the impact. Where will it cause any trouble? Will it cause any big recession? If not, then maybe next quarter I cut a bit more. I cut a bit more. So it is like the inverse lah for stock market. So personally, I think that it won't be as aggressive as what a lot of people will think like. Yeah.
I see, I see. Thanks for your answer for that. So in your opinion, just now you mentioned about the 4% dividend portfolio that you're looking at, right? So
Yes.
but now the T-bills or the money market funds are giving around that kind of figures.
Mhm.
So do you think that it's still worth it to look for stocks to generate 4%? Why not
Yeah,
just,
very good
T-bill
question.
and chill?
Yeah. Very good question there. Yeah, to be honest, right, I also looking at the T bill. Actually, I want to do one more YouTube video about fixed deposit and T bills next week or next week. Yeah, so I've been looking at them. Personally, I mean, I have a lot of uh, friends lah also looking at this kind of low risk investments. But I want to stress that this is not the norm lah, in the sense that you know if you look at the past few months, the rates are also coming down by a bit. The fixed deposits rates by the banks, last time they even stretched until 4%, right? I think there's a time close to 4%, but it's gradually coming down. And I think yesterday when I went down to the branch itself, I actually saw that they have really dropped to 3% or 2.9%, around that region. So I don't believe that the T bills will continue at that 3 point something percent for long. And when I talk about 4% retirement rule, right, I don't just focus on like 4% dividend yield. So there are a lot of stocks with maybe 5%, 6%. On top of that, because they are able to give out such high dividend yields, they will be able to grow their stock price returns. So that means like for example if I were to invest in Raffles Medical at $1, they give maybe 3% or 4% dividend yield. If their share price goes up to $1.20, that's already a 20% capital gain, which you will never get it from T bills itself. Yeah, so uh, if you were to go for total returns, capital gains plus dividend yields, that will definitely be exceeding the T bills by a wide margin. Yeah.
I see, I see. Understand. Okay, great. Thank you, James. That's all the questions we have for you today. So, thank you so much for your time. Any last words for our attendees before I hand over to the next speaker?
Yeah, I just want to say a very big thank you to all the attendees who have just joined this webinar. Once again, if you want to find out more about other stocks, be it Singapore stocks or US stocks, right, just join my YouTube channel. And every time I have a new video, actually, I just published one today, I think 1 hour ago. So just type it inside the comments lah. Just let me know Right now my channel is still very small, so if you have any stock that you want me to analyze, right, I will do it for you lah. So like let's say you want me to go through Singtel, I will just do it in my upcoming videos. Yeah, so thank you everyone for attending this webinar. Yeah, thank you Richard as well.
No problem. You're most welcome, James. Thank you for your time.